Millions of people face a shocking reality each tax season. Many Americans owe the IRS instead of getting expected refunds. This situation affects roughly 30% of all tax filers every year. Over 50 million individuals end up owing more money. A primary cause is incorrect tax withholding. Your W 4 form instructs employers on how much tax to deduct from each paycheck. Failing to update this form after major life events causes problems. Maybe you got married or divorced. Perhaps you had a new baby or adopted a child. You might have started a second job or received a significant raise. All these changes impact your tax liability dramatically. If your withholding is too low, you will owe taxes. If it is too high, you will get a refund. Many people simply do not check their withholding regularly enough. It is recommended to review your W 4 at least once a year. A good time is early in the new calendar year or after any big personal or financial change. About 25% of taxpayers do not adjust their W 4 forms for more than 5 years. This can create a cumulative deficit of thousands of dollars. The Tax Cuts and Jobs Act of 2017 also played a massive role. This pivotal law dramatically changed the tax landscape. It nearly doubled the standard deduction amount for many filers. For a single person, the standard deduction increased to $12,950 in 2022. For married filing jointly, it went to $25,900. This substantial increase meant far fewer people itemized deductions. Before this law, over 40% of taxpayers itemized their deductions. Now that number is closer to 10% each year. The new law also capped the state and local tax deduction at $10,000. This directly affected millions of homeowners in high-tax states like California, New York, and New Jersey. Those states often have property taxes alone exceeding $10,000 annually. Many individuals lost significant deductions they previously relied on for years. Their overall taxable income became much higher due to these changes. The personal exemption, which was a $4,050 deduction per person, was completely losing these benefits directly translated to higher tax bills for many households. The rapid rise of the gig economy complicates matters even more profoundly. Millions of Americans earn income through various platforms like Uber, Lyft, DoorDash, Etsy, and freelance writing sites. These individuals operate as independent contractors. They do not have taxes withheld from their paychecks by the platforms. An estimated 59 million Americans now work in the gig economy in some capacity. Most of them do not receive traditional W 2 forms. Instead, they typically get 1099 forms or similar reporting documents. This critical difference means they are solely responsible for paying estimated taxes quarterly throughout the year. If you expect to owe at least $1,000 in tax, you must pay estimated taxes. Many new gig workers are simply unaware of this fundamental rule. They often end up with a surprisingly large tax bill in April. This bill frequently includes self-employment tax, which covers Social Security and Medicare contributions. That is an additional 15.3% on net earnings from self-employment. Underpaying estimated taxes can also result in costly penalties from the IRS. These penalties can easily add hundreds of dollars to your final tax liability. Investment income is another common and often overlooked reason for owing taxes. If you sold stocks, bonds, or cryptocurrencies for a profit, you have realized capital gains, short-term capital gains from assets held for less than 1 year, are taxed as ordinary income rates. Long-term capital gains from assets held for more than 1 year have more favorable, lower rates. Many investors are genuinely surprised by this distinction. The cryptocurrency market alone reached over $1 trillion in overall value in recent years, attracting millions of new investors. Many individuals made significant profits from these digital assets. They often did not proactively account for the tax implications of their trades. Dividends from stocks and interest earned from savings accounts or bonds also count as fully taxable income. These various sources of passive income do not typically have any tax withholding. It is alarmingly easy to overlook these amounts when meticulously calculating your annual tax liability. A single stock sale profit of $5,000 can easily translate to hundreds of dollars in additional tax owed. Unexpected life events also frequently contribute to owing money to the IRS. Selling a home at a significant profit might create a capital gains tax liability. There are generous exclusions for primary residences, but specific conditions rigorously apply. For instance, if you sold a home you lived in for less than 2 years, you might owe capital gains taxes. If your profit exceeded $250,000 for a single person or $500,000 for married filing jointly, you could owe substantial tax. Retirement distributions also play a significant role. If you took money from an IRA or 401k before age 59 and a half, you might face early withdrawal penalties. Even regular distributions from traditional IRAs are considered fully taxable income. They increase your overall income for the year. Sometimes these distributions push people into higher income tax brackets. That directly results in a larger tax bill than they initially anticipated. Healthcare subsidies are another frequent source of unexpected tax surprises. Many people receive premium tax credits to help pay for health insurance obtained through the government marketplace. These are officially known as Advanced Premium Tax Credits, or APTC. They're estimated based on your projected income for the entire year. If your actual income ends up higher than what you initially estimated, you likely received too much subsidy. You will then have to repay some or all of that excess amount. This repayment directly reduces any tax refund you were expecting. It could even unexpectedly create a tax bill that you must pay. Millions of Americans actively adjust their income estimates throughout the year. But many more do not take this proactive step. A change in job or a significant raise can dramatically alter your income level. It is critically important to report income changes to the marketplace promptly. This simple action helps prevent large and unwelcome repayments at tax time. Misunderstanding basic tax rules also plays a very big part in this phenomenon. Some people intentionally reduce their withholding to have more take home pay each month. They mistakenly believe it is inherently better to owe a small amount of money than to receive a large tax refund. A large refund essentially means you gave the government an interest free loan throughout the entire year. While that statement is technically true, a significant tax bill in April can be a major financial strain for many families. It is generally better to aim for a perfect balance. Owing a small amount, like a few $100s, is often considered ideal by financial advisors. This means your withholding was almost perfect. Getting a huge refund means you significantly overpaid throughout the year. Owing a huge amount, conversely, means you substantially underpaid. Both extremes represent less than optimal financial planning strategies. Educating yourself on fundamental tax concepts is absolutely vital for financial health. The IRS offers free online tools like its tax withholding estimator. Less than 10% taxpayers actually utilize this valuable tool. This is a huge missed opportunity for millions. Underpayment penalties are a very real concern for many taxpayers. The IRS strictly expects you to pay taxes as you earn your income. This is achieved through either employer withholding or by making estimated payments yourself. If you owe $1,000 or more when you file your return, you will very likely face a penalty. There are specific exceptions to this rule, however. You can typically avoid penalties if you paid at least 90% of the current year's total tax liability. Or if you paid 100% of your prior year's total tax liability. For high-income taxpayers earning over $150,000, the prior year threshold is increased to 110%. These nuanced rules catch many people completely off guard. They often do not realize how much total income they truly had, or they simply forget about making estimated payments. These penalties are usually a small percentage of the underpaid amount, but they absolutely add up over time. An underpayment penalty could range from $50 to $500, or even more depending on the severity of the underpayment. Many taxpayers do not fully realize that tax laws are constantly changing. Congress frequently passes new legislation. The IRS regularly issues new guidance and interpretations. What worked perfectly last year might not work at all this year. For example, certain education credits, energy efficiency credits, or business depreciation rules might change or expire. Always checking the current year's specific tax laws is incredibly important. This is especially true if you are a small business owner or self-employed individual. Business expenses and deductions can be exceptionally complex. Claiming too many deductions might raise unwanted red flags with the IRS. Claiming too few, conversely, means you pay more than is legally required. The US tax code is truly immense. There are literally hundreds of pages of instructions for just the basic tax forms. Most people simply do not read them. They rely heavily on tax software programs or professional tax preparers, but having a fundamental understanding of the basics helps you catch potential errors. Finally, some people simply make avoidable calculation errors. They might inadvertently enter the wrong numbers on their tax forms, or they might forget to include a specific source of income altogether. Even seemingly simple mistakes can lead to very big differences in the final tax bill. Double checking all figures and entries is an extremely good practice. Many reputable tax preparation software programs automatically check for common errors. However, they inherently rely on the accuracy of the data you input. If you put in bad data, you will inevitably get bad results. Around 5% of all tax returns filed annually contain significant errors. This can easily lead to an unexpected notice from the IRS and a surprise tax bill. Sometimes this leads to a full-blown audit. Audits can be incredibly stressful and time-consuming. They typically affect less than 1% of taxpayers annually, but they can certainly be triggered by noticeable discrepancies. Being proactive about your entire tax situation is always the absolute best approach to financial peace. Avoid unwanted surprises, plan diligently ahead, ensure your withholding is perfectly correct for your specific circumstances and income,